So if you're looking at Constellation Brands right now, that's ticker STZ,
Hmm.
you're probably seeing what everyone else is seeing. A company that is, well, it's kind of under siege.
Oh, absolutely. The
Yep.
stock chart tells the story. It's been trending down, and not just a little.
Not at all. It's fallen 45% over the last year. A huge drop. And this pessimism, it really seems to stem from one big worry.
It's all about the next generation of consumers, isn't it?
Exactly. The narrative is that younger people, Gen Z, are just drinking less alcohol. They're leaning into sobriety or other things. And that means sales are in a fundamental decline.
And a 45% drop shows you the market believes it. Investors are basically saying the best days for this business are in the past.
Okay, but that's what makes this so interesting. And it's really the core of our deep dive today. Because you have all this gloom, the stock's getting hammered.
And yet,
And yet, Warren Buffett's Berkshire Hathaway has been buying quietly, consistently over the last few quarters.
it's a classic contrarian move. The entire world is running for the exit, and Buffett is just calmly walking in.
It's fascinating. And for a lot of people, this might be one of the last chances to really watch a big Buffett investment unfold before he eventually retires.
He must see something profound here, a strategic advantage that everyone else is completely missing.
That's our mission today. We're going to unpack the sources and look at the three core reasons why this investment, which looks so counterintuitive, might actually make perfect sense. Why it could be the last great value buy from Berkshire.
And to do that, you have to start with the business itself, its core products, and just how resilient they really are.
Let's do it. So Constellation Brands. This isn't some small niche company. About 95% of its revenue came from beer in the second quarter of their fiscal 2026.
And the brands in that division are absolute giants.
They really are. They have Pacifico, which is huge, and of course, Modelo.
Modelo is the #1 top-selling beer in the entire United States. That's not just market share, that is market dominance.
Right. So even if the whole pie is shrinking, they own the biggest slice by far.
But we do have to acknowledge the headwinds. The sources are very clear on this.
Well, for sure. Overall consumption has fallen. There's real competition from cannabis products, and there's a definite cultural shift towards health and wellness, especially with younger people. These are not imaginary trends.
No, they're very real, and they are exactly why the stock is down 45%. But this is where Buffett's mindset is so different. He's not just looking at the next quarter.
He's looking at human history.
He's betting on human habit. And here's where it gets really interesting.
I found this fact pretty surprising. Archaeologists have found evidence of people making beer for thousands of years.
Thousands. We're talking ancient Mesopotamia. This isn't a tech product that came out 10 years ago and could just disappear tomorrow. It's woven into the very fabric of human society.
So the idea that consumption will just completely stop because one generation is pulling back a bit, it seems unlikely from that long-term perspective.
It establishes a baseline, a kind of persistent demand that doesn't just vanish.
And that enduring quality is exactly what Buffett looks for. He calls them forever assets, right? Things with never-ending demand.
Yes, and the sources point to his other holdings that fit this exact mold. Coca-Cola is the obvious one.
Her.
But look at the others mentioned. NFM, the furniture retailer, or Justin Brands, the bootmaker.
At first glance, those don't seem like a beer company.
But the investment thesis is identical. People will always need furniture for their homes. People will always need sturdy, reliable boots. These are things with an almost inelastic demand over the very long run.
So Constellation is just a modern example of that.
Yeah.
Buffett is betting that whatever the current fad is, the basic human desire for this kind of beverage isn't going away. He's buying it while it's out of fashion.
Exactly. And that underlying stability, even if demand is a bit volatile right now, that provides the foundation for the second pillar of this whole investment.
Which is the income, the safety net.
The dividend.
Right. And Buffett has always loved a good, predictable dividend. I mean, think about his investments in Chevron or, again, Coca-Cola. He loves getting paid to wait.
A strong growing dividend is a sign of a mature cash-generating business. It cushions you against the stock price going up and down.
Let's get into the actual numbers here because they're pretty compelling. Constellation started paying a dividend back in 2015.
And they've raised it every single year since then. That's a perfect 10-year track record of dividend growth.
Which makes the current payout really attractive. It's, $4.08 per share annually.
That's right. And if you work that out against today's beaten-down stock price, You get a dividend yield of over 3.1%.
Over 3%. Let's put that in context for a second. The average dividend for the entire S&P 500 is about 1.1%.
So you're earning nearly 3 times the market average just for holding the stock while you wait for this stabilization that Buffett seems to be banking on.
Okay, but here's the critical question. Can they keep paying it? Especially if sales are weak. A high yield is no good if it gets cut tomorrow.
You have to stress test it. Look at the cash flow.
Right. So how much cash are they actually bringing in?
Over the last 12 months, so the last 4 reported quarters, Constellation generated $1.85 billion in free cash flow.
$1.85 billion. And what was the total cost of that dividend?
Just $724 million.
So they have over $1 billion in cash left over after paying the dividend.
A massive cushion. The payout isn't just stable, it's like over-engineered. It's not at risk. That's the kind of safety a conservative investor like Buffett absolutely needs to see.
So we've got a product with historical staying power and a rock-solid income stream. Which brings us to the third piece of the puzzle, the valuation.
The idea that the price drop itself has created the opportunity.
Exactly. When the market panics about the short term, quality assets can get really cheap.
So how cheap is it really?
Let's start with the standard metric, the price-to-earnings ratio, the PE. Right now, for Constellation, it's sitting at 19.
19, which, sounds reasonable on its own.
But compare it to the broader market. The S&P 500's average PE is 31 right now. So by that measure, STZ is already at a deep discount.
Okay, but I have to push back on that a little. A PE of 19 could be a value trap, couldn't it? If the earnings keeps falling, that 19 could look like 30 or 40 pretty fast. That's the risk.
And that's a fair point. But that's where the forward estimates come in and seem to justify the optimism.
Right. The forward PE is based on what analysts expect earnings to be over the next year.
And for Constellation, that forward PE drops all the way down to 11.
Wow, from 19 to 11. That's a huge drop. That tells you that analysts believe the worst of the earnings decline is already priced into the stock.
It signals they're looking past the recent bad news. I mean, revenue fell more than 10% in the first half of this fiscal year.
But the forward estimate suggests a stabilization point is coming.
When is that supposed to happen?
The consensus forecast points to fiscal 2027. So not this year, but next year.
And what's the prediction?
That after this year's expected 11% revenue drop, sales will basically level out in 2027. No big gain, but no big loss either. They stabilize.
And that stabilization is the trigger. Once the market sees that the bleeding has stopped, the stock can react very, very quickly.
And there's one more piece to this that really acts like a turbocharger for any recovery.
The share buyback.
The buybacks. The company has been actively repurchasing its own stock for years.
How much of an impact does that have?
It's significant. Over the last year alone, they've reduced the number of outstanding shares by 3%. The total is down to about 175 million shares, and it keeps falling.
So just to be clear for everyone, how does that actually help a shareholder?
Well, think of the company's profit as a pie. The buybacks reduce the number of slices. So your earnings per share automatically gets bigger, even if the pie itself doesn't grow.
So even if revenue just stabilizes in 2027 like they predict, earnings per share will still go up because of the buybacks.
Exactly. It magnifies the return for shareholders when that recovery finally hits.
Okay, let's try to pull all this together. On one hand, yes, there is risk here. You're buying a stock in a competitive industry where sales have recently been falling.
But on the other hand, a sober analysis shows this huge hidden opportunity. Constellation owns the biggest brands. It has inertia.
And you can buy into this dominant company at a really low valuation, a PE of 19 that's projected to fall to 11.
And while you wait for that turnaround, you collect a dividend that's almost 3 times the market average and is incredibly safe.
This combination, the low valuation, the secure income, and a management team actively shrinking the share count, it just screams classic Buffett.
It really does. Buy a great business when it's temporarily unpopular and get paid handsomely to wait for everyone else to come to their senses. The market's pessimism seems to have created the value here.
Which brings us all the way back to the beginning, back to that multi-millennial history of the product. The sources really suggest that the fate of Constellation Brands isn't just about the next earnings report. It's about whether thousands of years of human habit can be permanently broken by one generation's changing tastes.
It's a fascinating question.
It really is. And it leaves me with a final thought for you to chew on. What stands out to you about the wisdom, or maybe the risk, of betting on deep history over very powerful current trends?